Come on, 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, February 12th, 2022. It's been another great week of shows of BRN. We kicked off the week with relocation being on the mind of many. Let's take a look.
Yeah, it is. We really haven't seen much change. Some of our clients have decided to put off moving until COVID is completely gone, which, they're not sure when that's going to be, obviously. So that's kind of a moving target. But it hasn't slowed down. A lot more people are still kind of entwined in the, can I work remotely? And if I can, a lot of companies still haven't determined if they're going to bring everybody back, what that's going to look like. So there's still a lot of people out there who are looking at their options, still asking their company, can I work remotely permanently? Or maybe just be able to come back in once a month. And so, we're continuing to see that trend for people who have corporate positions. It's just a lot of it depends on kind of where you're coming from. The Northeast, obviously, a lot of people are moving down into the Florida area, Georgia, the Carolinas. So we're seeing a lot of that. From the Northwest, we've got a lot of people, the California is feeding typically into the Phoenix area, Las Vegas area, as I should say, Southern California, mostly feeding into Phoenix, Las Vegas, also into Dallas. Northern California, San Francisco, a lot of people going into Sacramento, to be able to kind of stay just about an hour and a half, 2 hours away from being in San Francisco, but being able to be out of the city. The Northwest, Seattle, those areas, also coming into Phoenix and some areas of Idaho. So we're certainly continuing to see the people moving out of the coasts, which tend to be the more expensive areas, that are moving into areas that are still less expensive, but quickly becoming more pricey as these shifts take place. Traditionally, we've seen it people who are at or near retirement who are saying, we've built up a good amount of equity, especially if they live in one of these, high cost of housing areas, and realizing that our nest egg is not going to go as far if we stay here. So we need to get to an area that's going to have lower taxes, lower costs of living, and maybe something that's going to be a better fit for our lifestyle. So we've seen that, over the past 6 or 7 years. That's been really nothing new. What we've seen change quite a bit is the working families and individuals who are making a good income. You could have a husband and wife in San Francisco or LA making $250,000, $300,000 combined income, and they're scraping to get by. So you can bet that they're going to jump at the opportunity to be able to get to a lower cost of living area, lower cost of housing, lower taxes, just everything that you purchase in general. So that's where we're seeing the most movement on, and that's where we're still seeing people, really push, their bosses in the HR department. Hey, if we're reducing our footprint for the office by 50%, can I be one of those people, can take advantage of it and work remotely? So that's where we've seen more of the people have an interest and really pushing, to be able to have more flexibility in working remotely. It's interesting because Arizona's governor, Doug Ducey, just put out a press release a couple of days ago and said, essentially, we'd love to have you here, everybody from California, Oregon, Washington. We'd love to have you here, but please understand the reasons you came here. And let's keep, the quality of life the same that it is. And I think, people probably know where I'm going with that.
Yeah.
As far as the infrastructure is concerned, most places have anticipated, maybe not as quickly as it has taken place, but they've anticipated this type of growth. So most of the areas have, looked at what are going to be the water requirements for new subdivisions for builders. What are we going to need to have as far as transportation, whether it's public transportation or, increased access to freeways, things like that. So I think a lot of them have thought ahead about that. It's certainly happening quicker than they probably anticipated. And in most of these areas, there's still new construction taking place, but builders can't build quick enough for the demand that's coming in, whether it's local demand for housing or people coming in from out of area, demand for housing. So that's a struggle in almost every market right now. And that's why we've seen in a lot of these areas we're talking about, Las Vegas, Phoenix, Dallas, we've seen price increases, of $150,000 to $200,000 in the last 18 months, maybe 24 months. It's significant.
Wow. And with food prices on the rise, we discussed nutritional alternatives. Let's take a look.
Yeah, definitely. I see it myself. I'm going to the grocery stores now, and I'm seeing chicken has increased, beef has increased, fruits and vegetables. So my biggest advice would be shop for what's in season. So usually what's in season will be a little bit cheaper than we would see of stuff that's not in season. And that's because there's a larger volume of it, right? And they want to kind of sell it. That's like the first thing I would suggest. The second thing is people tend to look down on frozen or canned vegetables or fruit. And I encourage people, it's one of the things I tell my clients, like, don't feel bad about having frozen fruits or vegetables in your freezer. They're actually more nutritious. And people are always like, how is that possible that something is fresh is not as nutritious as something frozen? And the reason for that is because when they pick the fruit or vegetable that they're going to be freezing, they actually pick it at the peak ripeness. So they leave it on the stem for as long as they possibly can. So it's getting all the nutrients it needs from the soil and from the sun. And then they freeze it. So it's like at peak ripeness, has all the nutrients that it needs, compared to a tomato or apple that you would get at the grocery store. They typically pick it before ripeness, and then it kind of ripens on its own without getting that nutrients. So definitely, I always tell people, go for frozen. My freezer always has frozen broccoli, has frozen spinach. I use it all the time. Great thing to add into your food. I always suggest two things when it comes to protein. If it's a good price, buy it and freeze it. When it comes to turkey or meat, even like deli meats too. Deli meats can stay up in your freezer for 2 to 3 months. Beef and poultry can stay in your freezer for up to 9 months to a year. So you can buy things in bulk and freeze it, and it'll be just as fresh when you thaw it and cook it. So that's always like my thing too. Like if you're finding a good deal, take advantage of it, and fish too. Fish is between like 6 to 8 months in the freezer. You want it not to like extend it longer than that. But other sources, if that's out of your price range at the moment, is legumes and beans. So even like dried beans, lentils has between like 18 grams of protein in a cup, 15 grams of protein in all different size sources of beans as well. You'll find 15 grams in a cup. So you can get protein other places. And you mentioned Greek yogurt. It's one of my favorite things. And cottage cheese is another one too. And people tend to always do cottage cheese as like sweet, right? They'll put some honey and some fruit, but I always do it a savory way because I prefer savory over sweet, with some tomatoes and like the banana peppers or pepperoncinis. Add that on there. It's so good. So there's definitely a lot of different ways to get your protein in. And it's not bad to use coupon books, right? So kind of looking for those deals and seeing what has a better price, shopping at different grocery stores. Aldi has great prices. We have that here, and you can definitely find it a little bit more cheaper than other places. Might not have as good variety, but you'll find great things there, and the products they have are great. So yeah, there's definitely just looking out, researching, and always getting the discounts from like being a member for that store, right? You'll see like all these things, buy one, get one free, buy one, get one 50% off. Like I kind of said with the poultry, getting it and freezing it. I do the same thing with my breads too. If it's a buy one, get one free toast, I'll do it. I'll buy one, get one free, put the other one in the freezer, and it lasts like for a couple months in the freezer. So,
well, certainly great segments, but we're only halfway through. When we come back, we'll take a look at the other half of some great segments here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Defined contribution retirement plans continue to evolve in a lot of ways, and that includes alternative investments like real estate. Let's take a look.
Yeah, so we fielded two distinct partnerships or surveys in partnership with DCREC and NAREM, really each targeting a unique set of participants. So we had the manager survey, which was targeted to real estate investment managers actively managing defined contribution capital, really with the goal of gathering information on things like capital raising, how they're structuring their products, organizational metrics, and then general best practices in the space. And then separate and apart from that, we also fielded a survey targeted to defined contribution investors in order to understand their perspectives around private real estate, how they think about allocations, their desired product structure, and how they prefer to access real estate. And in both cases, really kind of the key takeaway from the survey was that you can really see the momentum in the space. So as an example, capital raising has really increased over the past several years. And for most of the managers in the survey, and as a result, so have their assets under management. And so when you look at aggregate AUM across the sample set, it's really increased by about 24% over the last 5 years. And I think what this really shows us is that there is greater demand for and broader adoption of private real estate among plan sponsors. And it's also reflective of the fact that you have new market entrants coming in and new introduction of new products by existing managers. So I think that this is certainly a trend we're going to see continue with broader plan adoption going forward. And likewise, more managers entering the space, really with the aim of getting exposure to this very significant investor channel.
You know, many of the listeners today may be surprised to learn that private real estate's been in DC plans for over 30 years. But the real evolution has occurred in the last 5 to 10 years as private real estate has shifted from a standalone option on the core menu to a sleeve within a professionally managed asset allocation solution, such as a target date fund. The industry has also come together during this time, and we've created greater standardization around how these investments can be incorporated into DC plans. And that includes areas such as daily valuation and liquidity management. So we often find the case for real estate is well understood. The real education comes around the mechanics of how we make the investments work in a daily valued environment. Another factor is the growing use of consultants and outsourced CIO services, which have certainly been supportive over the years of using diversifiers such as private real estate as they seek to help DC clients incorporate asset classes that have historically been offered in DB plans. Lastly, I'd say there's simply more choice. 10 years ago, there were only a few daily valued private real estate products available for the DC space. Today, there are 15 products for fiduciaries to choose from. So there's a true marketplace with differentiated choice. The survey did address and provide some insights in this area. So we found that 2/3 of respondents from the survey use packaged or off-the-shelf solutions. And these combine private real estate with a built-in liquidity sleeve, usually REITs. And 2/3 were using a single fund manager. That leaves a third that are utilizing custom solutions and a third that are using more than one manager. So the statistics around customization and multi-manager approaches do seem to point to increasing sophistication of the investor set. As you mentioned, it might also be indicative of consultant and OCIO involvement in structuring these solutions, which we're certainly seeing more of. And I'd say in addition to the survey results, anecdotally, we see broader thinking around the application of real estate in DC plans. So in addition to target date funds, investors are incorporating real estate into white label solutions. So think of a white labeled real asset fund, for example. We're also seeing emerging interest in other areas such as private real estate debt. So that all seems to point to increasing investor sophistication. The diversification that's gained from private real estate often comes in the form of downside protection. The stable income that you get from the rents generated by these products, it often smooths the ride for participants in DC plans. So when you take and analyze maximum downside scenarios, even using a modest allocation to private real estate can improve risk-adjusted returns and your downside capture ratios. And of course, in private real estate, there's also the opportunity for capital appreciation in the asset. So that combination of potential for upside capture and downside protection, we believe has the ability to positively impact long-term participant outcomes. Well, real estate does tend to weather inflationary periods well, given that commercial property rents are typically increasing as prices increase. And in fact, the survey, we did ask the top reasons for investing in real estate, and the top 3 reasons were diversification, risk-adjusted returns, and inflation hedging. Beyond the survey, investors are demonstrating increased appreciation for income that real estate can provide to a portfolio. So this is definitely an emerging trend we'll continue to monitor closely in future iterations of the survey.
So the survey will be an annual effort, and we're really looking forward to this year's launch, which will come in spring 2022. And just like last year, we'll have 2 distinct surveys, one really targeted to managers and one targeted to investors. And the idea is really to continue to refine, make sure that we're on the cutting edge of kind of bringing this important information to the industry. And as the industry grows and the sector grows, to make sure that the survey itself also grows and reflects that in terms of broader participation, deeper and more robust questions, and really making sure that we're bringing those actionable insights to the industry.
And lastly, but not least, the SEC is flagging risks for credit rating agencies interested in the ESG boom. Let's take a look.
It's just a sign of the greater focus on all aspects of ESG now. I mean, everybody's kind of trying to work out A, what they're doing today, and B, what the demands are going to be and where the market's going to go tomorrow. And as is true in a lot of situations, the credit rating agencies have this interesting position kind of in the middle of a lot of moving parts. And so they're in a situation where they're coming up with opinions about companies, but at the same time, those companies are clients of theirs. And so if they don't handle the both the incentives properly and the optics properly, they can get into trouble. So the SEC just wants to make sure that there's not motivation for the credit rating agencies to, as we saw, back in 2008, there was a very big big issues around some of the credit rating agency actions there. And what we don't want is a repeat of that same situation when it comes to ESG rating. But even where you've got checks and balances in place, you have to make sure that they're working. And regulation isn't a matter of coming up with something that's theoretically ideal, setting it down and then leaving that in place forever. Your circumstances change and incentives change on individuals. And so it's right that where something that maybe was a reasonably off to the side issue starts to become center stage and these ratings become ever more important and the role that they're playing takes on greater significance, it's right that the regulator would look at that and say, okay, is this functioning as it should? Is it continue to function in a way that's good for the market? As things develop, as it becomes a bigger deal, do we need to look at additional checks and balances? So I think it's right that the regulator would want to keep an eye on what's going on and to basically to make sure that you don't have any organization that's sitting in the middle of the market that has an incentive to do something which isn't ultimately in the consumer's best interest. And so if you've got somebody, if the financial incentive pulling in one direction becomes too big, it can start to undermine advice. And so it's become a concern really just because these ratings have started to take on ever greater importance. They're starting to have more influence. And so it's natural that you'd want to say, are these pure? Can we trust these? And we see them, the disclaimers that are now at the bottom of every time you have an analyst talking. And this was a reaction to situations that arose. Incentives got too misaligned, and they had to step in. Now I don't know whether it's going to be necessary to step in or not in this particular instance, but it is a reflection of the fact that the ESG ratings are becoming ever more important, and we want to make sure that we can rely on them. Again, one of the areas it's so important for the regulators to make sure that everything's functioning as it should, because it's really difficult to get the right optics and the right information that you want about companies on these points. I mean, if I want to know what a company's sales are, I can look at the financials, and sure, there are ways that accountants can manipulate them and make the sales, but by and large, that number's reasonably objective, and it's the mental impact, social impact, a whole wide range of issues. It's really, really hard to get clear, objective data telling you about how well a company's doing. And so we are in a situation where a lot of these ratings that are coming out, very much opinions, it's very much best information. And with the best will in the world, as an outsider, you go into a company and you're trying to judge how good a job it's doing of managing some of these risks associated with ESG factors. And it's a really opaque area, and there's a lot of judgment in it. So it's real information. It's really important to the performance of a company. If you're not doing a good job environmentally, if you're not doing a good job socially, if the company's culture sucks, that's going to hurt you in the long term. But for, as you say, even professional investors to look in from the outside and reach a judgment on that, that's a real skill. And so the industry is building up its capabilities. It's building up the analyst strength to try to do a better job of measuring those things. But they're naturally difficult things to get good information on. And there's a supply and demand thing here. The more users of this information become skilled in using it, you start to work out, well, that number smells wrong. Can we trust it? And companies that maybe are putting a positive shine on numbers at the moment, it becomes harder and harder to do that because the users of the numbers get more skillful. So I think everybody kind of advances together. The disclosure gets better. The users of the disclosure start to work out what they need and what they don't need. Again, none of us want this pile of paper with a bunch of numbers that mean nothing because they're required to be disclosed. So finding that right balance between meaningful disclosure and effective disclosure is it's something we're all going to work towards. And everybody has an interest in making sure that we do start to measure companies and hold them to account for the impacts that they're having, beyond just the financial profits that they're making.
Well, that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest in lifestyle, finance, wellness, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives and see our latest content? Well, check out our website. That's www.broadcastretirementnetwork.com, and our streaming partners like Amazon, Roku, Samsung, so many more. There's over 100, so check them all out. We're back again tomorrow for BRN Sunday. We'll be joined by members of the media, academia, and financial services as we analyze all the news and events for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.